Most people think the government prints our money, but here's the truth. The majority of the money in circulation wasn't printed at all. It was created by banks. Every time you take out a loan like a mortgage, car loans, or student loans, brand new money is born. Sounds crazy, right? Let me show you how it actually works. To start off, what exactly is a bank? In simple terms, a bank is in the business of managing money. They keep your money safe, protecting it from theft, and at the same time, they lend it out to people who need it, whether that's someone buying a house, starting a business, or paying for school. Think of banks as the middleman in almost every transaction. They make it easy for you to pay bills, transfer money to friends, or even shop online without carrying cash. When you swipe your debit or credit card, it's the bank that makes sure the money moves from your account to the seller's account. It's important to note a bank makes money off every loan through interest payments. But the real question is, how can a bank lend out money and still make sure you can withdraw yours whenever you need it? That's where bank reserves come into play. When you deposit money into a bank, the bank doesn't just lock it all in a vault. Instead, they keep a small portion of deposits on hand. This is called the reserve. The reserve ensures the bank can meet withdrawal demands from customers, like when you take out cash or pay with your card. Think of it like a safety cushion. If you or other customers want to withdraw money, the bank can cover those requests without any problems. The size of the reserve is usually set by government rules, called reserve requirements, to make sure banks don't run out of cash. The rest of your deposit isn't idle. It gets loaned out to others. This is how banks earn money through interest, and how new money enters the economy. Keeping only a fraction of deposits while lending the rest is what makes the modern banking system work, and it's called fractional reserve banking. Here's how it works. Let's say Jim deposits $10,000 into the bank. The bank will take 10% of Jim's deposit, $1,000, and put it into the reserve. This reserve acts as a safety cushion to make sure Jim and other customers can withdraw money whenever they need it. The rest of Jim's deposit, $9,000, isn't just sitting idle. The bank can lend it out to other people, like George, who needs $9,000 to buy a used car. When George buys the car, the dealer receives the $9,000 and deposits it into the bank. Now the bank takes 10% of that $9,000, $900, and puts it into its reserve, keeping the rest available to lend out again for someone like Alex, who needs $8,100 for a renovation. This cycle continues. Dozens of transactions later, the bank could potentially support $100,000 circulating in the economy from Jim's original $10,000 deposit. This means the bank has effectively created $90,000 in new money from that single deposit, out of thin air. Imagine larger amounts and thousands of transactions later, and adding interest to those loans, you can see why banks are so wealthy. In a nutshell, banks take a small percentage of your money and put it in a reserve for liquidity purposes, and use the rest of it to make money through lending. But fractional reserve banking isn't without risks. Because banks only keep a fraction of deposits in reserve, they rely on most people not withdrawing their money all at once. If too many people try to take their money out at the same time, a situation called a bank run, the bank might not have enough cash on hand to cover everyone. Here's an example. Imagine this channel owned a bank with $10,000 in reserve. A rumour spreads that the bank is about to collapse because it has low cash reserves. Fear spreads, and customers rush to withdraw their savings. Let's say 5 people each demand $3,000. That's $15,000 total, but the bank only has $10,000. It doesn't have enough to pay everyone, so it collapses and files for bankruptcy. Another risk is too much debt in the economy. When banks create money through loans, they also create obligations that borrowers must repay with interest. If borrowers default on their loans, meaning borrowers don't pay back the loans, banks can lose money, which can ripple through the economy and cause financial instability. A real-life example is the 2008 financial crisis. During the 2008 financial crisis, many banks had issued risky mortgages to borrowers who couldn't afford them. When these borrowers defaulted, banks suffered massive losses. Some banks even collapsed, and the crisis spread throughout the economy, leading to job losses, foreclosures, and a severe recession. This shows how too much debt and loan defaults can threaten not just individual banks, but the entire financial system. While fractional reserve banking has risks, there are solutions and safeguards to reduce these risks. Central banks like the Federal Reserve in the US monitor banks closely to ensure they maintain reserves and can provide emergency loans if a bank runs into trouble, acting as a lender of last resort. Governments also set rules requiring banks to keep a minimum fraction of deposits in reserve, making sure there is always some cash available for withdrawals. On top of that, programs like the FDIC in the United States protect customer deposits up to a certain limit if a bank fails, which prevents panic withdrawals and reduces the likelihood of bank runs. Banks themselves are encouraged to lend responsibly, giving loans only to borrowers who are likely to repay, hence your credit score, and to spread their loans across many customers and sectors, so a single default doesn't threaten the entire bank. So next time you swipe your card or take out a loan, remember this: most of the money in our economy doesn't even exist until someone borrows it. Banks create it, debt fuels it, and trust holds it all together. We hope you enjoyed the video. Please like and subscribe for more.